Today is the 1st of January 2021 and I just put in an order to max out my Roth IRA. If you want to know why I chose to do this, then stick around. Happy New Year everyone! Welcome to the first episode of Finance with Arjun in 2021. For those of you just discovering me this year, my name is Arjun and I make videos on personal finance and investing. Please consider liking this video and subscribing to the channel if that sort of content interests you. In today's video, I'm going to talk about why I decided to max out my Roth IRA on January 1st instead of splitting it out into equal payments throughout the year like most people do. Technically, the order will end up getting executed only on January 4th because 1st is a holiday and 2nd and 3rd are the weekend. Basically, what I did is called a lump sum investment. And the other strategy of splitting it up into periodic payments, that's called dollar cost averaging. Before I tell you about why I chose one strategy over the other, let's talk a little bit more about these strategies, starting with DCA. Dollar cost averaging is the process of investing a fixed amount of money into the market at regular intervals, usually on a monthly basis. For example, if you invest $500 every month over the course of the year, then you're dollar cost averaging into the market. Your 401k generally tends to follow this method where you invest a portion of your paycheck every 2 weeks or whatever your pay schedule is like. By doing this, you buy more shares when the price is low and fewer shares when the price is high. Many people swear by dollar cost averaging because it has some solid benefits. It reduces the emotional component in investing. A lot of times people get emotionally swayed by what's going on in the market. If the market is up, they buy more than they should, thinking that the market will continue going up. But when the market is down, they tend to freak out and panic sell. Dollar cost averaging removes this emotional component by investing a fixed amount irrespective of what's happening in the market. It's also more affordable. You aren't put in a situation where you have a big lump sum to invest very often, especially as a salaried professional. Dollar cost averaging allows you to invest even small amounts periodically from your paychecks. Lump sum investing, on the other hand, is the process of investing all of your money on hand at once. That can be into one stock, a combination of stocks, an ETF, or whatever that may be. The entire investment is made at a single point of time, rather than spread out over time. An example of this is what I did with my Roth IRA, where I invested the entire amount at once. Other examples of this would be if you get a bonus at work or an inheritance and choose to invest it all in one go. The benefit of this approach is that there's a chance for higher returns. This is because you give your money more time in the market. Since the market trends upwards, you tend to make more money most of the time. You will also have lower transaction fees versus DCA because you only have to make the trades once. But this is less of a concern nowadays because most brokerages offer commission-free trades. So why did I choose the lump sum investing route for my Roth IRA? Well, there was a study done by Vanguard, which is probably the most trusted name in the finance space, where they compared the total gains from dollar cost averaging versus lump sum investing. The study consisted of 3 markets, US, UK, and Australia, ranging from 1926 all the way up to the end of 2011. What they found was that 67% of the time, lump sum investing outperformed dollar cost averaging. I'll leave a link in the description box below if you want to read more. Now, I am not saying that this is the right approach for everybody because past data does not guarantee future performance. I'm just outlining what exactly I did and the reasoning behind it. Since I had the $6,000 ready, I decided that the smart move from a mathematical standpoint would be to invest it all at the beginning of the year. This was just extra buffer money that I had saved up in 2020 in case the situation got really bad. And this was over and above my emergency fund. Now that things are starting to look a little bit better, I didn't think that leaving it in a savings account getting 0.5% interest was the best idea. And since I don't have a better use for that money right now, that's why I decided to invest it all into my Roth IRA. Was that the right thing to do in the current climate? Only time will tell. For all I know, the market could drop 25% in the next couple of months and I'll be down for the year. From a numbers perspective, what I did does make sense, but it's these sort of situations where you need to be careful. You could stand to lose a lot if you invest just before a crash, and that can be hard to stomach. But I'm in it for the long haul. So if the market drops 10, 20, 30%, I know that I will not panic sell. And that makes me a little bit more confident in my decision. You might be wondering whether the same principles apply to the 401k as well. The answer is yes and no. There are folks out there who try to max out their 401k early on in the year so that they can benefit from more time in the market. This is what we call as front loading of the 401k. Obviously, it might not be possible to max out in the first month like the IRA because the limits for a 401k are much higher. But it is possible to contribute larger amounts and max out in 4 or 5 months, say. Here, what you need to watch out for is the company match schedule. Some plans will only match contributions if an employee contributes during that pay period. So this means if you max out your 401k by April, you'll be missing out on the employer match for the rest of the months. So make sure to check the details of your own plan before making any decisions. If whatever I've talked about so far has been really confusing and you're not sure what to do, let me try and simplify everything into a few lines. Dollar cost averaging removes the emotional component by buying irrespective of price. So this method is generally better suited to newer investors who want to minimize risk. On the flip side, more experienced investors who are willing to take on a little more risk can look at lump sum investing to gain exposure to the market as soon as possible. At the end of the day, there's not too much of a difference between the gains of these two strategies. Lump sum investing does win most of the time, but with DCA, you're still building a great habit while taking away the effects of market timing. The most important thing is that you are investing, whether that be your 401k, your IRA, or even just your taxable brokerage. Both the methods I spoke about offer higher potential gains than just leaving your money in a savings account. Hopefully this video was useful to you all and it gave you a little bit more to think about for your investments this year. I for one am super stoked to see what 2021 has in store for us. So let's lean into it with positive intent and go out and crush our goals. Thank you all for watching once again. I'll see you next time.